you're watching Market Trap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICI Direct. Very good afternoon, Pankaj, and welcome to the show.
Hi, good afternoon, Gitu.
Pankaj, the trending hashtag this week has been COVID is not over. And that to some extent has spoiled the party for bulls, and market has become a bit cautious. Are you really concerned about the crisis that we are seeing in China spreading out to the entire world, or we can say that market was overdue for a healthy correction, and this is just a trigger that led to a sharp fall?
So our sense is that overall one needs to be cautious on the COVID front because see, none of us are sort of doctors to sort of understand the medical emergency it can create. But at the same time, our sense is that it is not going to create the kind of panic which we witnessed in the previous waves. And there are reasons for it. So one is, for example, if you look at 68% of global population of say around 800 crore has been vaccinated with one dose. So
Right.
about 1,300 crore kind of vaccinations have been already administered. I think the concept of herd immunity is also there because a large section of population has been exposed to virus. So obviously, herd immunity is also has sort of come in. The other thing is
Mhm.
that hospitals and pharma companies are a lot more better prepared than what we have seen in case of previous COVID waves. And I
Mhm.
think the other good part is that overall, our sense is that there's a decent amount of sharing of data in terms of detecting viruses. So from that perspective, I think the standard operating procedure to sort of deal with COVID is there. So from that
Mhm.
perspective, our sense it is not going to sort of cause any major damage to the global economy. And which is why I would still want to believe that despite this sort of triggering a near-term correction in the stocks,
Mhm.
overall it's a sort of a part of a healthy correction because markets were waiting for some kind of a news to sort of do profit booking, and probably this was sort of a good enough news for that. So
Okay.
from that perspective, I think we are not expecting that kind of a negativity or panic the way it produced in the previous waves.
Okay. So what is your expectation now? Now that we have corrected from 18,900 levels to 18,100 levels, some more bit of correction required because technically, if we say it's a crucial support at around 18,000, but if it breaks below that, will you be a buyer?
So I think what also happens that a lot of people also know that 18,200 or 100 is a good technical support. So market usually sort of in cases of these usually breaches those levels just to create the kind of panic. So it is
Okay.
possible that probably 17,800, 900 could come by.
Mm-hmm.
But having said that, like I said, there's no major sort of a panic to be into because we have already dealt with this kind of a crisis globally. In fact, all the nations have sort of dealt with a crisis of this kind overall. So yes, there
Mm-hmm.
is a need for cautiousness, but our overall sense is that market will find its feet, and I think for the next one decade, India looks a lot more brighter than a lot of other global economies.
Let's keep our fingers crossed and stay optimistic. So, what is your outlook for 2023 now? Because next week is the last week of this year, 2022. The 2022 year will be coming to an end. So, what is the outlook for 2023 as far as the Nifty levels are concerned? And which are the stocks and the sectors that you like the most?
So for next year, our overall Nifty target is 19,400, 500, which is where both the technical and fundamental views reside.
Mhm.
And overall, before I sort of come to that, I think what I would also want to sort of highlight is how do we see the next decade, which is 2020 to 2030. Now,
Okay.
we have seen historically that markets like US or Nikkei, they've done phenomenally well with returns of say 5 times during that particular decade. And which is
Mhm.
why we feel that Indian economy or Indian markets are on course of doing what they have already done historically. And
Mhm.
basis that, our sense is that by 2030, Nifty could be about 55, 56,000. And every
Okay.
third and fourth year, we have seen markets turning positive or giving returns of 18 and 15 odd percent. So 2023 is the third year. So 17-18% kind of a return is very much possible. And
Okay.
I think from current levels of Nifty broadly, you will sort of get there. And the other
Mm-hmm.
part is that obviously you'll not see markets moving in a linear fashion. So you'll obviously have periods of time correction. So
Mm-hmm.
when you sort of look at it in this entire decade, we have only sort of traveled only a smaller portion of it. The bulk of the upside is still sort of residing. And besides the second and fourth year, our sense is that even your years like say ninth year, third year, fourth year, and second year. So all of them are have been historically very positive for the market. So
Mm-hmm.
from that perspective, we're quite positive on the market. Mid caps, small caps should do well. The market breadth is also in supportive of that. Sector-wise, our sense is that banking and financial services, autos, PSUs, capital goods, infra should do well. And
Okay.
overall, our sense is that with this kind of a shorter, quick correction, what we are seeing, I think markets will recover from these levels because this is a third week of sort of correction, and we haven't seen markets sort of correcting more than third week. So hopefully
Mm-hmm.
from next week onward, from say shade below 18,000 kind of a levels,
Mm-hmm.
we should recoup some of the losses what we have seen in this particular week.
Pankaj, one of the space that has seen some bit of attraction is pharma space of because of the obvious reasons that the massive surge that we have seen of COVID cases in China is getting the world a bit cautious. So, what is your view on the pharma space now? Now, the kind of interest that we have seen in last few days, is it really going to sustain?
So I think it's a very interesting thing to sort of note out because as China is sort of witnessing massive amount of COVID wave, now the perspective is that there will be higher demand for basic drugs such as ibuprofen or paracetamol or anti-infectives like azithromycin. Now, it is possible that China might impose curbs on some of these products
Okay.
so that they'll not be exported. And when
Mm-hmm.
that happens, then it sort of presents an opportunity for Indian players or Indian API companies to sort of supply to US, Europe, or Latin America. And
Okay.
as a result of that, yes, there could be some bit of a windfall for some of these companies like say IOL Chemicals, Solara. But having said that, what you are seeing is still not a very confirmative kind of a situation. So it is possible that the COVID cases in China might rise, but in a very shorter span of time, you might see herd immunity sort of also creeping in. So I think
Okay.
all these are sort of trading calls. We are still not very sure that this is going. This is sort of a structural turnaround in some of these names. And
Okay.
same is the case with even diagnostic also, because if yes,
Mm-hmm.
India, if we find some cases in India, there is a possibility that the overall testing can sort of go up. But our
Mm-hmm.
sense is that all these are sort of more of trading calls rather than sort of being a structural nature. So from
Mm-hmm.
that perspective, I think pharma, we are still sort of very guarded in terms of what we prefer. So what we typically prefer in pharma is domestic companies,
Okay.
largely because there the growth rate is more secular. Same is the case with hospitals. I think there also you have number of metrics which is sort of improving, and it is one sector where there is an expectation of secular growth. And then you can have case-based companies like Sun Pharma is what one can look at, where there could be improvement largely driven by specialty products. Rest of all, I think, is still sort of a trading play. One should not really be chasing just because there is a bit of a COVID wave in China, and it is not going to probably produce similar price action the way what we have seen previously. So pharma, I think one needs to be very selective. One should not really jump into with this in perspective that if COVID wave is in China, then we are going to see a repeat of the previous pharma rally. So I don't think that is going to happen.
I remember Pankaj till last week we were talking about hotel and travel industry doing very well, but this week we have seen a bit of profit booking in some of the good top ranking hotel names. And that has been because of the concerns that COVID-19 cases are rising in China, and that may have a fallout on rest of the world. So, what is your take on the hotel? Will you still stay bullish?
Well, yes, I think what you're seeing is more of a temporary correction, given the fact that we've seen a pretty good run up in most of your hotel stocks. But our sense is that the best is yet to come for hotel as a overall industry, because you have number of events lined up domestically, which is going to support. And I think whatever near-term concerns you are seeing in terms of foreign tourist arrivals, I think that has also not picked up, because we have seen that in a normal year, you will see more than 1.1 crore foreign tourist arrivals coming into the country.
Okay.
But because of COVID last year, that number was 50 lakhs. So it's not that you have seen an entire recovery from pre-COVID levels. So which is why from a lower base, our sense is that you will not see much of a damage to those numbers. Yes, there could be some bit of a cautiousness for an interim period. But like I said, I don't think it is going to sort of create that kind of a panic. So yes, I think near-term correction in all these stocks is a sort of a good opportunity structurally. Our sense is that most of these stocks are headed well. Their earning profile is going to get a lot more better. Balance sheet is going to become a lot more better. So from that perspective, we are not sort of that worried on this particular front.
What is your take on the metal space? There has been a bit of recovery, resilience shown, consolidation seen as far as the prices are concerned. Can we expect some kind of a traction and interest back into the metal stocks? Because on one hand, we have crisis in China, where we talk about high COVID cases, but on the other hand, the government of China is easing COVID restriction policy. So, what is your view on the metal space as such?
So one is, I think, if in China, because of higher COVID cases, it does not look like that the government is going to go for a strict lockdown, which means that overall production for key commodities, especially metals, is not going to sort of wane much. And on top of it, yes, they have been sort of announcing stimulus in limited measures. So what we have seen historically is that whenever there has been a easing of COVID situation in China, China has been producing more, and that has or that metal has found its way in the global markets, and in a way, it has pressured the metal prices. But in the last fortnight, if you look at base metal prices, be it copper, be it aluminum, so they have largely remained range bound. And steel prices have seen a sort of an uptick of 5 to 6%. So our
Okay.
sense is that overall, unless we don't see sort of lockdowns coming in, I think even rising COVID cases may not materially impact metal as a overall pack. Now, the only unsurety or what one is not sure of how the Chinese growth will pan out. So, which is why I think metal as a overall sector will remain volatile, because when a country produces 45 to 50% of the global metal production or contributes that much, and is not sure about the growth trajectory, what would come by. So from that perspective, uh, nothing, no major risk concerns have emanated in the recent times. But yes, volatility is going to remain there, because we still don't know how whether China will grow at 4% or whether it will grow at 3%. So that is something which is still sort of not known at this point in time.
Let's talk about the FMCG space, Pankaj. There has been some bit of cool off in the input prices. For example, your crude is down at around $80 per barrel. Your palm oil has come down by 30 to 50%. So, what is your view on the FMCG space? Do you see quarter three margins expanding for some of these big names?
So in FMCG, what happens that typically when the market is sort of a bit of a turbulent mode, these stocks sort of find favor. And what we have seen in case of FMCG in the last, say, 2021 or first half of 22 was that the raw material prices or input prices had gone up to 3x, and
Okay.
companies had to sort of pass it on. There was a margin pressure. Now all that is sort of reversing. So our sense is that overall companies will witness margin expansion because of the lower input prices. The other perspective is that we have seen higher commodity prices. So for example, wheat prices, which used to be about 21, 22 rupees a kg, those are now 28, 29 rupees a kg. So all these higher agri product prices, our sense is that can give a boost of nearly 2.5 lakh crore in terms of rural income. which is sort of a big number. And our sense is that that should sort of drive the overall rural volumes, which has been sort of tepid. And
Okay.
since the volumes or since the margins were under pressure, companies had to take a sort of price hike that impacted volumes. But now that will also sort of return to normalcy. So I think
Mhm.
both domestic, both urban as well as rural segments are looking a lot more brighter. Plus, there is a margin recovery which we are expecting in the coming quarter. While obviously they will do higher ad spends, but even with that, our sense is that they will continue to witness margin expansion, and which is why we like this space selectively. With something like say ITC or Tata Consumer or Dabur with a target price of 700 and ITC with a target price of 405.
Let's talk about the private banking space. This space did not perform as the public sector banks performed in last 2 3 months. The rally that we saw in PSU space. Now that the PSU banks in the mid size segment and in the frontline stocks like SBI are seeing are witnessing a bit of profit booking, is it time to look at some of the mid-sized private banks?
So I think when you sort of look at, we have seen a good, fairly 60-70% kind of a move in PSU banks, including smaller banks. I think large sector private banks have already been doing well for the past, say, 9 to 12 months. I think it is the only mid-sized private sector banks which haven't really sort of done that well. And our sense is that this is one segment which has been sort of ignored. And probably here, our sense is that this is one segment which can sort of do a catch up compared to the rest of the pairs. I think the PSU banks or larger private sector banks could witness some bit of a profit taking given the fact that we have seen already a good sort of run up. In fact, we have also highlighted last week itself that PSU banks can correct 25-30 odd percent given the sharp move what we have seen. But coming to mid-sized private sector banks, I think you have interesting names sort of coming up. There is a decent amount of turnaround, say, for example, an IDFC First Bank. I think the balance sheet restructuring is largely done, and now the focus is on credit growth. CASA is good at 51%. Also, there's no major concerns on the asset quality side. I think one key variable what needs to be tracked is the cost to income ratio, which is at about 73%, expected to sort of come down to 55%. So this is one bank in the mid-size which can be looked at. IndusInd Bank is another bank which hasn't really sort of performed. So our sense is that this bank also can sort of do a bit of a catch up in terms of valuation. One. Then I think we are seeing a good revival in credit growth plus retail portfolio. So 18 to 20% kind of a growth in advances is very much possible. I think gross NPA slippages or credit cost is largely done. So from that perspective, provisionings are likely to moderate. ROAs will improve to about 1.6 to 1.7%. And it can get a value of 1.8 on FY24, and which is why I feel that it can also do a catch up where our target price is 1350.
What is your view on the government capital expenditure? If we look at the first half of FY23, it has been buoyant. It has stayed buoyant. Private investment is yet to pick up. Do you expect this kind of a momentum continue into 2023 too?
So I think before I come to that, when we sort of look at historically how things are sort of different. So for example, between 2004 to 2010, so in that period of time, the project under execution was somewhere about 16.5 lakh crores.
Okay.
Right. Whereas when you sort of look at now, the project under execution is 116 lakh crores. So that is the kind of a delta what we are seeing in the last, say, decade or slightly more than that. Similarly, average annual tendering used to be, say, somewhere about 4 lakh crores, say, between a period of, say, 12 to 16. Whereas what
Okay.
you see now is about 11 lakh crores. So from that perspective, there has been a shift in orbit in terms of project under execution or the kind of tendering what we have seen. Last 4 5 years, there has been 18% kind of a growth, and the capital allocation has grown at 23%. I think government has made it amply very clear that capex is something they are going to sort of stick with. So, which is why I think this is one theme which is sort of looking a lot more brighter, and that stays the way. And I don't see any kind of a disappointment even from the budget perspective, even
Mhm.
though you'll see election after that, because our sense is that government is not really going to sort of change its template for growth. So that way, I think capex as a cycle remains strong.
So, who will be the key beneficiaries of this capex?
So one obviously is the hidden gem, which I'll talk about, but we like the entire sort of space. I mean, when you look at three major capex, one is road. In road, you will have something like KNR construction, PNC infra, or you have rail. So in rail, you have number of players. Some of the EPC side could be something like KEC International.
Mhm.
Or L&T, or and then you'll have defense, which we all know that you have players like HAL, BDL, Bharat Electronics, so all of these.
Mhm.
So from that perspective, it's a very broad sort of theme where a lot of these segments will get benefited over a period of time.
Mhm. Let's now talk about hidden gem. So, which is the company that you're going to talk about today?
So it's a very well-known name. So L&T is what I'm sort of recommending. It's obviously a large cap with 3 lakh crore plus market cap. So target price is 2,355. Now we all know
Mhm.
that it is India's one of the largest EPC companies, and they've been doing projects in EPC, high-tech manufacturing, everything. And what we are liking is that with the pickup in capex and overall fairly diversified exposure, I think this is the best stock to sort of play the capex theme. And company
Okay.
has been guiding for a 15% kind of a CAGR growth rate, similar order inflow growth rate, and also a far more improved ROE of about 18%. I mean, recent news also, if you look at, there is a clear focus on asset monetization, be it road or be it power plants. And overall, our sense is that their order book log is pretty strong at about 3,70,000 odd crores. So this is one company which should sort of do well. Our overall sense is that the earning CAGR could be about 16%. And then obviously, if there is a revival in IT, it also benefits from the perspective that the holding, since it holds both in LTI Mindtree as well as LTTS. So overall, it is a beneficiary of any kind of a reversal in the global fortunes of IT companies. So from
Mhm.
that perspective, I think L&T looks quite attractive. We haven't seen that kind of outperformance from a big stock like L&T last year. But our sense
Mhm.
is that next year probably it could outperform the Nifty by a good margin.
Mhm. So, hidden gem for this week is LNT with a target price that is been given is 2355. Uh, okay, Pankaj, now that we have a very volatile session this week, what is expected of next week and how would you play the markets?
So I think very difficult to say that volatility is going to subside next week. So our sense is that since COVID cases or news related to that will be the highlight of the agenda, so volatility is definitely expected. So which is why I'm sort of shifting focus from an overall year perspective. So last year we have seen a clear outperformance compared to the global markets, and our sense is that probably that could also work out in CY23 also.
Mhm.
And while recent COVID wave can cause some disruption, but like I said, this is India's decade, so one should ride India's decade with conviction. I think 2020 to 2030, Indian markets probably will do a lot more better than any of the global markets.
Pankaj, thank you so much for sharing your views on the market and the outlook for coming years and the decade ahead. Thank you so much.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.